Welcome back. You're still watching Crystal Ball, the 2016 Outlook edition. I've been in conversation with Rhythm Desai of Morgan Stanley. What about banking, Rhythm? I mean, I was going through your focus portfolio, and you have a couple of high-quality names there, like HDFC Bank and IndusInd Bank. But even there, you seem to be saying, through your portfolio at least, that stick to quality out here because it could still be a hairy year for financials.
Yeah, so I think, Udayan, first of all, on this, the whole market has actually seen a bit of a shift. In fact, I think it may not have escaped your attention and a lot of other people's attention that quality persistently lost performance in the second half. And defensive sectors also lost performance. So even though the market was down about 8 or 9% in the second half, it came at the expense of quality and defensives. Cyclicals and so-called high beta stocks did measurably better. So in a way it was a very odd market, because if the market is falling, you would not expect that to happen. I think this is happening because a lot of quality stocks are very richly valued, and therefore you have to be careful about buying too much of quality in your portfolio. I would be a little bit more cyclical and a bit more attentive to the starting point of valuations that you pay up to buy a business. That said, I think in the banking sector we continue to remain cautious on SOE banks, and therefore we have to veer towards private sector banks. I would argue actually that private sector banks are not that richly valued, and therefore they do not fit the conventional quality theme which has been persistent in the market over the last 4 or 5 years, which is buy expensive quality names and you are okay. So I think a lot of private banks actually are trading at reasonable valuations. But as I said, I think you have to be careful about stuffing portfolios with too much of quality, which has been the anchoring of the market for the past 4 or 5 years.
You know, the other segment of the market which people look at closely these days, given the fall in crude, has been the oil sensitives, whether it's aviation or oil marketing companies. I don't see too many of that in your focus list. Any reason?
No, that's also to do with the coverage that we may have as a firm. So my focus list only consists of companies that we cover rather than a broader universe of companies. But I would also argue that I think the best of the oil sensitives is behind us. The trade I wouldn't use the first phrase done and dusted, but a large part of it is actually done in 2015. And even if oil were to fall from here, there's not that much gain that the oil sensitives will make. So what I would like to see is, or buy companies who have used this fall in commodity prices, generally speaking, not just oil, because it's not only oil that fell in 2015, and invested in their business for growth, rather than report better margins in the next few quarters and show high profits, because we don't know how sustainable this is, and therefore the companies that tend to take this gain and invest it, I think will be rewarded by the markets. So that's the way I would pursue the oil sensitives. But as I said, I think a lot of the upside is already baked in the cake.
If you had to bet on either consumption or capex as a theme for 2016, what would you lean towards in India?
So I think the two things that dragged the economy down in 2015 were rural consumption and private capex. Arguably, government capex has done quite okay, and urban consumption has shown measurable signs of recovery, especially in the second half. So I think the question, if I were to further narrow it down, would be whether I would bet on rural consumption versus private capex, and I think I would go for the former. I think rural consumption, in my view, is bottoming out, albeit keep in mind that we should not get another bad monsoon. The early weather forecast from sources outside India suggests that we may be entering into a La Nina after one of the most, or rather I should say the most severe El Nino that the world has witnessed since the 70s. And if it is a La Nina, it means India will get bountiful rainfall, and that will actually help. But even without that, assuming that we get a modest monsoon, I think rural consumption may have seen its worst. Rural consumption took a lot of hits in 14 and 15 to start with, the compression in wage growth that happened, which I think caused real wage growth in rural India to actually turn negative. Then it was followed by the fall in food price inflation, and then a bad monsoon. So a lot of those hits I think are in the bag. So I would bet on rural consumption. We in fact just finished a survey, a proprietary survey of India's top 200 companies, and it doesn't look like private capex is about to start. In fact, most companies are saying that for the next 1 or 2 years they don't intend to actually start on new projects. Doesn't surprise me, because I think there's still a fair bit of excess capacity in the system, especially in the commodity sector, which, you know, if you go back to the capex cycle of 03 to 08, 50% of private corporate capex happened in 2 sectors, downstream energy and steel. Now, I don't think anybody wants to set up new refining capacity and new steel capacity in a world where there's so much of excess capacity in both those sectors. So other sectors need to find their footing and grab the pie. And I think that may take time. You know, outside the internet economy, I don't see that much investment happening in the private sector. So it looks like private capex will continue to perform in a sluggish fashion, whereas rural consumption could turn. I think urban consumption is probably going to look stronger. Therefore, overall, I think consumption will probably outperform capex. I'm still bullish on government capex. I think what they've done in 2015 looks encouraging, and that should continue in 2016.
What's the best way to play this rural consumption revival? I mean, do you stick to the tried and tested M&M, two-wheelers kind of themes, or do you look at areas like agri-related companies or even consumer durables? What in your way is the best way to climb that tree?
In fact, all of them are actually embedded in our focus list. So I think quite a few of them should do quite well. Whether it's in the auto space, whether it's in durables, I would say even retail, because some of that goes into semi-urban and rural India, and you know, even the agri plays. So I think all of them have scope for improved performance in 2016.
What is your most contrarian call for 2016 in terms of portfolio preference? Something which the street does not like, but you happen to.
So I think, Udyan, that's rural consumption, because I think today the consensus is that rural consumption is not going to recover in a hurry. And probably that's the theme that stands out versus the consensus. The other place where we have been out of consensus is in our bullishness on technology. And I was just looking at the data yesterday. Technology is going to end this year as the best performing sector in the second half of 2015. It has actually even surprised me that it's done that well, because I did not actually think that technology is doing that well. But I think that may sustain, because one of the calls we have globally is that the bull run in the dollar is not yet over. And when I'm choosing a dollar-oriented sector, to me technology looks a lot better than, say, pharmaceuticals, where the valuation headwind is still strong. It's coming off, but it's still strong. Therefore, I think technology could also be one of those out-of-consensus calls that we have.
How do you see deflationary trends or deflation as a threat locally and globally for 2016? Because it's something which the world is struggling with. Even in India, there seems to be some sense of deflationary winds blowing, which is preventing a lot of companies from coming out and saying that I don't have the confidence yet to go out and invest in a big way. Do you see that becoming a bigger problem?
No, absolutely, Udyan. In fact, that's one of the key risk factors we highlight for 2016, which is that deflationary trends persist. And certainly that won't augur well for earnings. Because if I look back on 2015, we were far more optimistic on earnings than what we actually got. And when I analyze why that happened, one of the key bottom-up constituents of that earnings forecast going wrong was the fact that we got more severe deflation than we anticipated. On a top-down basis, it happened because the government's fiscal deficit actually came lower than our forecast. And global trade collapsed in a manner in which we were not forecasting. So, you know, these were the three things that fed into earnings. Deflation was part of the story, and that continues to be the case, and it's certainly a headwind for earnings. We've had negative revenue growth as a consequence of that, and if the PPI or what we call as WPI stays in the -4, -3% range, it's difficult for revenue growth to recover. And if revenue growth does not recover, it is difficult for profits to recover. So even though margins are expanding, profits are not. So I would definitely make that one of my key risk factors for 2016. You know, bottom line is that India needs a bit of stability in the commodity price situation. Albeit it has benefited us a lot in terms of improving our terms of trade, which I think look the best they have been in several years. It has helped us rebalance our saving. It has helped us in stemming inflation. But I think now we want commodity prices to stabilize. That will be symptomatic of a more stable global growth environment. It's essential for absolute earnings in India to recover.
Rhythm, always a pleasure. Thank you very much for your time today. You have a great 2016.
Thank you. Same to you, Udayan. Same to your viewers.